Hi everyone. This first question was asked by whom? I forget his name. Let me just check. It was asked by Nitish. Nitish has asked how to identify undervalued and overvalued stocks. So, how do you undervalued and overvalued stocks? First, let's talk about for undervalued stocks what you should look at. Then we'll talk about what to look at for overvalued stocks. Undervalued stocks. The first thing which we look at is the PE ratio. The PE ratio should be compared to the industrial average should be lower. If the PE ratio is below the industrial average for that specific industry or the market, then it's considered to be undervalued. And this can apply to companies, can apply to sectors, and it can even apply to countries. Right now, India's Nifty is considered to be overvalued because we are well above the 20-year average. While you take other countries like UK and Japan, for instance, those are all considered undervalued because historically their stock index PEs have been much higher. So that is the way it's looked at. So if you look at an individual company like a Tata Steel or any company you want to look at, you look at the steel sector and you look at the average PE of that sector, and then you can look at this specific company and see how is that across that industry. So something like a steel or a cement industry might have an average PE of 8, while FMGC sector will have an average PE index of weighted average might be around 55. So that's what I'm saying. You have to look at it sector wise also. You just don't look at it broadly speaking. But as a beginner, if you're looking at it, you should always broadly look if to start with. If you're a beginner and not worry about the sector. And in India, we usually take 15 as a value investor, 15 as the historical average for the Indian stock market. So if anything is below 15, it's considered to be undervalued. And if it's above 15, it is considered to be overvalued. This is for price to earnings, PE. The next thing which you look at is known as price to book. Price to book in India, we only look at usually at finance companies and banking companies, and we don't usually apply PE to banks and financial companies. I don't want to get into why into this video. That you can read Anand's book, or you can do a little bit of Google and find out why, because it's a video which I have to cover many things. So if I deep dive into price to book, why not price to earnings, I'd consume the entire video. So in price to book for financial companies and banks, you should look for a PE value less than 1. If it's less than 1, it's considered to be cheap. If it's more than 1, it's considered to be expensive. That's why all the banks our team is usually looking at will be banks where the price to book ratio is below 1 and is considered to be attractive. South Indian Bank, Karnataka Bank, there are banks which are below 1. And if you look at ICICI, HDFC, they're well above 1. They might be even in 3, 4, 5 going upwards. So those are considered very expensive in price to book. So those are considered overvalued. This is the two main things which you need to look at if you're a beginner. Another thing which you can look at is called the dividend yield. The higher the dividend yield, especially compared to the industry average, might indicate undervaluation. I only said indicate, I didn't say it is. So let's say the cement industry is giving a certain dividend yield, and this company is giving a higher dividend yield, then sometimes is considered as an undervalued company. Also depends on the price. So the first one is price to earnings. Remember this. Then comes to this. Then, of course, earnings to growth. If companies have a strong historical or projected earning growth that's consistent, then this is also considered to be undervalued. If you look at the earnings growth and it's consistent, and the first tick off is a price to earnings, you look at the price to earnings looks attractive, then you look at the growth, earnings to growth. If that has been historically projected and it's strong, then it's also undervalued, suggesting there is more growth in this company, underlying value is there. The other one to look at is the debt to equity ratio. A low to debt equity ratio shows significant stability in the company. It might not mean the company is undervalued. It means the company is in a very financially very strong position. Usually, Anand will want debt to be zero. It might not be that the company's debt is zero. So you look at the debt to equity ratio, which is nothing but debt divided by equity. And that ratio, if it's low, that means the company is financially very stable because it can easily pay off its debt if it wanted to. The next thing which you look for undervalued stocks is you look for the free cash flow. If it has a healthy and increasing free cash flow and a positive sign, and it's often overlooked by many people. Shashwat keeps talking about this quite often in the videos when he's covering them. Free cash flow is very important because even Charlie talks about this. If a company is making a lot of free cash, that means it's making a lot of money. And it's a very healthy sign. All of us are investing in companies to make money. And if you see a company which is making a lot of free cash, then it's doing very well. So you can look at that companies which are having a good free cash flow also. And maybe those prices might be undervalued when you look at the price. Another thing which you look for undervalued companies, which you should also pay attention to, is the management and the business model. The company's management is very important to look at. Is it sustainable? Are they strong? And what is their business model? And what have they been doing historically? This is something you should look into by reading about the company's annual reports and seeing what they've been doing for the last at least 5-6 years to see what they've been doing. This will also give you some idea in is this company a good value or not. Another thing which you should look at is the whole sector performance. Sometimes entire sector might be undervalued due to market conditions. This happens sometimes, like Chinese steel suddenly starts flooding the market, then Indian steel companies gets depressed. But this is not a prolonged period. It's a short-term market effect. So after that, when the industry recovers, it'll bounce back. So you can look at it like that. I just gave this an analogy. I'm not asking you to look at the Indian steel sector right now. I need to give an example for you to understand. So I mentioned. So you can look at its sectorial also. So let's say you talk about IT. Let's say the rupee suddenly becomes very strong against the dollar or very weak. It has effects on the pharma and the IT sectors. So those are all temporary. And when the market has knee-jerk reactions, you can look at those sectors as undervalued and maybe see an opportunity to buy. What is considered as overvalue is if the PE ratio is very high. First, straight off the bat, the reverse of what I first said, the PE ratio is very high. That means the company is being paid too much for what it's worth. It's overvalued, especially when you compare it against the historical average or the industrial average. If it's very high, that means it's completely overvalued. This is what Anand keeps on famously saying. Diamond needle, you cannot take your diamond needle and poke your eye out. It'll still make you blind. Then the high price to sale ratio. High price to sale ratio indicates a stock is overvalued, particularly significant in higher than industry norms. If the industry norm has a certain price to sale ratio, and if your company which you're looking at is other thing which you should look at if it's overvalued is declining and earnings are stagnant, meaning it's staying at the same level year after year, quarter after quarter, it's not moving, or if it's starting to decline, that means the company is certainly not worth the price is being told in the market. There's something to sell, and these are the main things which I would say you should look at. I've been faffing on a little bit, but broadly speaking, price to earnings and price to book, look at those two. If it's a non-finance, price to earnings. If it's a finance, price to book. Then after that, you can go into the other things. If the price to earnings is attractive and it looks good, then you can do all the other analysis, basically what I've just said. That should tell you if the stock is a good buy or if it's not a good buy right now. Thanks you for watching the video, and I'll see you in the next one soon. Bye.
So after Kuwait, my team has decided to do an event in Trivandrum. Those who are desirous of meeting me in Trivandrum can contact our team at trivandrummp@gmail.com, the mail ID given below, or the WhatsApp number given below. My team would fill in you with the details. The event would be in January 2024. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.